Well, it was a good year for the Thai stock market. If you take a look at 2015 or 2014 rather, as the SET had gone up by 15% and also the MAI 96%. So you would think that 2015 would be a good year for investors. Well, think twice. One of the famous and popular analysts here in Thailand, the director of Mbmg Group Investment Advisory, Paul Gamble, says that you have to be careful indeed if you have your bucks in the stock market, whether here in Thailand or across the world, because you could stand to lose up to 50% of your investment. Here's what he had to say.
Because the real economy has been quite weak globally for quite a long period of time. This has been one of the lowest periods of growth following a recession. It's been one of the lowest recoveries, one of the slowest recoveries. We've seen very poor employment recovery across the globe, really. And so I think everything that we're seeing with the oil price is nothing new, it's nothing shocking. It's really just a reflection of the fact that the global economy hasn't been doing very well for quite a long period of time. And I think what is maybe perhaps a little bit of a surprise to some people is that even though the global economy was doing badly, a lot of asset prices were doing okay. So stock markets have been doing okay despite the weak global economy. And that's really been a reflection of the kind of economic policy that we've seen since 2008, 2009. So economic policy has supported asset prices, but it hasn't done anything to really help the economy. And eventually, that starts to show through, and it starts to show through first in areas like commodities. And eventually, when we can't ignore that anymore, it starts to show through in other asset prices like equities. So if nothing happens from here, if we don't get any policy response from here, then actually we think that it's quite a weak outlook for equities going forwards. Having said that, we do think that some policymakers are likely to maybe panic or certainly to respond to this. And particularly, we've seen that in Japan. The Japanese policy response to their own economic problems, to recession, to the sales slowdown because of the sales tax, they really seem to have panicked like crazy. And so I think that will support, if you get that kind of a reaction, that will support asset prices in the short term. It'll help to push stock prices back up. We saw that in Japan. Japan was having a terrible period in the stock market. We got this policy response. It pushed the stock market back up. But it can't keep it there unless they keep doing more and more of this kind of policy. It can't keep it there. And this kind of policy doesn't help the real economy. So what we're seeing is just a catch-up between asset prices that were too high and they were being kept high by policy like stimulus, like quantitative easing, like twist and extending bond maturities, and in Japan's case, like forcing the pension funds to go and buy stocks. So we're seeing that has pushed asset prices up, but it's actually not helped the real economy. That gap got wider and wider, and what we're seeing in commodity markets, what we're seeing in equity markets is narrowing that gap. That gap has got a long way to come down, but we don't think the policymakers are just going to let it. We expect them to try to do something more, some extra forms of stimulus, and therefore the outlook really is very volatile. When we get stimulus, it's going to stimulate and support asset prices. When we don't, it's going to let asset prices start to come down towards where they should be based on the level of the real economy. And really, this is the dilemma that we face for quite a long time ahead until policymakers accept that what they're doing isn't sustainable and it isn't going to help the real economy. Until then, in which case, I think we're due for, at some point, a very, very big correction in equity markets. And I think probably the biggest bubble out there is the US equity market. And I think we have to expect US equity markets to fall by more than 50% at some point. But when that happens, only the policymakers know.
So investors should stay away from the market?
It depends on how much appetite they have for risk. If they feel very brave, And if they want to try and capture the upside of policy response, they could certainly take their chances on it. But if you invest in any equity market in the world right now, you have to be aware of the fact that there's a good chance that you could lose at least 50% of your capital at some point, and it might take a long time for that to bounce back. So you've got to base it on your own risk. We think for most investors, you have to kind of protect that downside, and so we think that probably exposures to equity should be limited for most investors. And we think if you do take exposure to equity, try and take it in a way that protects the downside. So we look at absolute return strategies, we look at long-short hedge strategies, and we also, there's an ETF which is a version of the MSCI World Index, but it picks only those stocks that are the least volatile. So MSCI World Index low volatility is maybe a good way to try to protect the downside. We think if you want to chase the upside, be aware what the downside is. There are a lot of risks out there in the market that people don't seem to be fully aware of at the moment. So, for instance, if we look at oil companies, if we look at all the shale boom that's happened in the States, a lot of that has been financed by high-yield debt. Now, there's a very big high-yield and junk bond debt market in the States, not just in oil, not just in shale. If we see a reaction in the shale high-yield and in the oil high-yield sector, that could flow over to the entire U.S. high-yield sector. That could, in turn, have an impact on the whole U.S. corporate bond sector. The risk of bankruptcies isn't just in oil companies. The risk of bankruptcies flows to any company that needs to go and raise money through the bond market if it means that there's a reaction that affects the entire corporate bond market. So, this thing that starts with the oil price, follows through to oil companies, follows through to high-yield debt, this could actually be the beginning of something more serious, and I think that's one reason why we do expect policymakers to act. If they know what the risks are, I think they'll try and head it off. Now, that might actually make it much worse in the long term, but we think they're too frightened in the short term. So we think that we will see some kind of a reaction from policymakers. And everybody talks about Russia. I think it's the American market. I think it's the American corporate debt market, and I think it's the American equity market that's actually most vulnerable from a reaction to profit margin squeeze and to inability to service debt amongst the oil sector.
และนั่นก็คือนักวิเคราะห์จาก Mbmg Group Investment Advisory นะคะคือ Paul Gamble ซึ่งถ้าเกิดสรุปใจความที่เขาพูดออกมาก็คือว่ายังไม่แน่ใจเลยว่าการลงทุนในตลาดหุ้นจะมีประโยชน์กับคุณหรือเปล่าในปีใหม่นี้เพราะว่าถ้าเกิดพูดถึงการฟื้นของการว่างงานในประเทศยุโรปหรืออเมริกาก็ยังเป็นปัญหาซึ่งนโยบายของรัฐบาลก็จะมุ่งเข้าไปเรื่องของ asset หรือว่าตลาดหุ้นซึ่งตอนนี้ก็เกิดอาการฟองสบู่พิเศษเลยในประเทศอเมริกาและเขาก็บอกว่ามีโอกาสที่ตลาดอเมริกาก็จะลดลงหรือว่ามี correction ถึง 50% so คุณควรที่จะทำยังไงก็บอกว่าก็ทำปลอดภัยไว้ก่อนถ้าเกิดจะลงทุนก็อาจจะลงทุนในฟันหรือว่า ETF ที่ปลอดภัยมากกว่า so there you go that is the negative or positive you could think about the aspect of the outlook for the equities market here in Thailand and the rest of the world. We just have to hope for the best, and of course you can always stay tuned here on Now 26 for Now at Noon for your English news, and of course follow me on Twitter at chao._now26. As for now, we wish you a happy new year. สวัสดีค่ะ